So I need to get better at Rocket League, and I also want to watch some startup videos and basically see what they have to say. I'll share some of my insights, the things that I've learned as just the average startup founder slash business consultant who's helped and works with on a day-to-day basis lots of companies. I just want to see what I can learn and maybe share a perspective that comes from a slightly different place, somewhere, not in Silicon Valley, someone with not those connections in that way, just working, building, and trying to, of course, support startups.
I would watch his life on Facebook and be like, this is amazing. He traveled the world, he got married, he had kids. I'm like, am I the idiot? And like, the evidence was like...
Quite possibly, Michael. Quite possibly.
This is Dalton plus Michael, and today we're going to talk about, should you bootstrap or should you start a VC-backed company? This is like a confusingly controversial topic.
Yeah.
I'm not really sure why it's controversial.
I think it's a little hard because of who these guys are and just how immense their backgrounds are and their track record, and also the Silicon Valley and, friends type geographies that they grew up in, because capital and startups and general entrepreneurship is so much more developed from like a cultural sense. So there's just more knowledge that people are making a lot of these decisions off of. And often when you get further out into different sub communities, right, they feel differently, and because of different the availability of resources, the availability of knowledge, of capital, whatever it might be, things are different. And a big question, because every startup that gets major news, other than, of course, a few of them, but the big guys, the ones that everyone hears about and reads the paper about, they're largely VC backed. And historically, a lot of news centers around the fact that X investor invested in this company. It's really only a thing in venture capital land. You notice you don't see it happening with, VCs are investing in private companies. Lots of companies invest in private companies all the time, but whether they invest in them partially, they buy them out, they buy a whole stake. So it's not really the same thing, but because of the media and the trends and just the dog and pony show that kind of basically has come about, getting capital became ingrained, almost like a marker of success. If you were a good startup, then you deserved VC capital. And if you worked hard enough, you could earn VC capital. And if you didn't, well, you didn't have the resources that you needed in order to progress your business. And depending on how you're building in the early days, if you're building very heavy capital or building, trying to use a lot of capital, guess what? If you don't get the money, you're in trouble. If you're building as a bootstrap founder, meaning relying on your own resources, both internally, but also what the business generates, you have a lot more flexibility, of course.
Well, it's one of those sort of one-sided things where a lot of people don't care about the topic versus people that care a lot.
Yeah.
Does that make sense?
Yeah.
And so I think there's a lot of people that strongly identify and are really excited about bootstrapping.
Yeah.
That are very fired up about this.
Yeah.
And there's a lot of people that this just isn't a topic that comes up much.
Yeah.
I also think a lot of people are fired up about bootstrapping and different things because they know the heavy cost that comes with taking on anyone as an investor, whether it's the bank and you have a loan, whether it's your mom and it's 10 grand, or whether it's some big fancy VC with, media teams and managing partners and industry connects and all this stuff. Like, there are costs and consequences and risks. And I think that a lot of people are, especially if you're like a serial founder or if you have experience raising money from investors, it's not that all investor relationships are bad by any means. There are a lot of incredible investors, but there's also equally a lot of not so credible and not so incredible investors. And you can imagine if someone not so incredible owned a chunk of your business, and then that business, because of one reason or another, especially if it was, influenced or driven by them, or you had to make decisions to try and grow quicker than you were comfortable because that was the expectation, and then the business blows up for some reason. Yeah, you can throw around fault here and fault there, but people get burned. And historically, there have also been a lot of VCs that have done not so great things with management once they get in there. Some for the better because it was to save the business, but others some because of greed. I mean, we're talking about the highest levels of finance and capital and investment. of course there's going to be some people that make some not so friendly business deals that end up making people on the other side, the bootstrapping side, wave the flag and just do everything they can to make people not want to raise capital because they've paid that price. They don't want others to have to pay the price. You know, it's a fair concern, even if it's not the right concern for every business, because there are a lot of great opportunities to raise capital and get invested by amazing VCs and angel investors and everybody else.
The place we should start, I think, is that the vast majority of businesses should not raise venture capital. And I'll extend that point. Venture capital is not interested in investing.
Yeah.
In the vast majority of businesses. So like,
he's completely right. And just to be clear, when we talk about businesses, this is kind of like a square rectangle thing. Every startup is a business, but not every business is a startup. Fundamentally, startups can take many forms, but generally speaking, they have characteristics such as high growth capabilities where you're able to grow and scale, you know, to tens of thousands of customers. That's way easier to do with a piece of software or with a piece of like tech enabled service offering or a marketplace or an app or what have you. It's way easier to do that than of course it is to go get 10,000 clients for your accounting firm. You need to do a lot more to scale that, to build that infrastructure. So if it's not scalable and, you know, high growth potential in that way, that's a super big risk. If it requires tons of capital to grow, meaning it's not efficient, not only does it have a difficult ability to grow from the sense of you have to hire all these people, but there's heavy cost associated with that forever. It's a fixed cost, right? Obviously, there's AI and there's this and there's that, but we're talking about like starting an accounting firm versus a software business. You can see how one lends itself to being so much more of a startup, just definitionally, because of the nature of their business model and, of course, what they're trying to do.
one of the things I think founders get really screwed up on is that VCs have become a little bit more marketing-y, right?
A little
Talking
bit more
to people, and they might be confused. Well, I want to start a restaurant. VCs don't want to fund your restaurant.
Yes. Well, I think another
Restaurants
thing
aren't
that's confusing
scalable.
is a
Not
side
like
note,
that.
is a lot of the stuff on Shark Tank,
Oh yeah.
I would argue, is not.
I am very mixed on Shark Tank. I remember in college, lots of people would watch it religiously. And even though I wasn't like a hyper startup, you know, early stage entrepreneurship build by any means type guy then, I could tell that it was more, again, it was more celebrity and more about the show than it was about good business, just based off of some of the more emotional or less logical type things that, you know, many of the sharks would say. And as I grew older and started to watch it more, obviously there's a ton of very accomplished people on it, but you have to remember that they're on a show. And so some of their reactions, emotions, thoughts, concerns that they may want to raise, maybe they don't want to bring it up on the show, or maybe it comes up later. You're watching a very small fraction of what due diligence fundamentally looks like to actually get that investment and get those partners. And depending on the product, the expectations can be very different. If a company, again, I don't remember what each of them own, but one of them owns, for example, that like TV where they can do like personal shopping and do all that stuff. If she buys a business or buys a product in terms of like partners with one of the people that appears on Shark Tank, she can automatically scale and distribute that and basically just turn it into a cash cow as long as she sees the product as being, efficient and in demand. But notice she didn't have to set up infrastructure. She didn't have to set up media rights. It already existed. So she's buying a product and then she has the ability to efficiently scale it herself already. You can imagine this is so much different than if you were just trying to create a random item and you went to China and tried to build it and you have to own that whole supply chain yourself versus being able to get supply chain economies of scale, distribution, media rights, all the things.
Venture capital backable. A lot of the stuff that I see on the television show, you would never in a million years be able to raise VC from it. And so I think you watch Shark Tank and you think that is reality.
It's not this industry. So I think that that's the first thing, is that if you're starting a business that can appear on Shark Tank, for the most part, you probably shouldn't raise venture capital. But I think there's actually like a deeper thing here, which is that let's say you want to start a startup business. You don't have to raise venture capital either.
Correct.
And
I wish more founders like could hear this video. I don't know how many views it has. Let's see. 149,000 views. I wish it was just that sentence is worth being heard by every founder across the planet. I have a buddy who's incredibly smart, does consulting, has worked with governments, just he's the real deal. He was talking to me about building a startup or doing something, you know, in that vein. And the first concern that he brought up on our phone call was, I just don't know if I want to, you know, take a couple $1 million and who am I going to raise it from and managing the investor relations. And I'm like, whoa. Like, before we get there, in order to build a successful business, you have to have demand for something and then the ability to provide that something. Right? There's legal, there's finance, there's blah, blah, blah. But fundamentally, it's, is there demand and is there supply? Can you facilitate it? Yay, you're a business person. Congratulations. But when you look beyond that, especially in startup land, there's all these, you know, implicit or explicit in some cases, it feels like rules about what it means to be successful. You know, if it's not $1 billion, it doesn't matter, which is just completely asinine, because if I handed you an extra 10 grand a month, it would change your entire life for the average person. And that means that's 120 grand a year in profit that your business has to make. Yeah, if you have to make $1 billion to make 120 grand, you have bigger problems, right? You can do so much with so little. And I get on the phone with this guy and I tell him, well, why do you have to raise money in the first place? What if you just built a piece of software that you used and was useful for you and your clients and the expertise that you've received from all of your, years consulting and all this stuff, and just make an offer and then just scale it? And I gave him that same kind of math. What would an extra 10 grand a month do? 20 grand a month, 30 grand a month? And he's like, I would do this, I would do this, I would do. And I'm like, well, then let's just do that. Let's just start there. Because you can always just sell that thing and then go raise 50 million from VC and then go do the thing. But if you haven't started, you don't have a place to, dig your heels into and keep pushing forward from. You have to start. And you also don't need other people's money or support to start. You just have to start. And it was so funny because he responded. It was kind of like a long silence on the call. And it was hilarious because he just goes, bro, I have never thought of that. I walked in just assuming and thinking, and I was so fixated on the investors, I couldn't see that there was a business before the investors come into play. And I'm like, yeah, and if you need them, get them. But notice you're coming to them as a decision based off what you need, not off of what you think the market requires of you in order to be successful. Set your own standard.
I'll say the same thing. I don't believe venture capitalists want to invest in all software businesses, and
they don't.
I don't believe all software founders should raise venture capital.
They shouldn't.
So
yeah, let's talk about them.
Yeah,
I think what's really going on is, I think if you looked at how many businesses are started.
Here's a fun one, just as like a quick reference point. Maybe this will help somebody. It's a good kind of litmus test of, is my business even worth considering for VC? If I was to tell you, let's assume you had your product and you were able to go generate sales and, you made $1 million across the first, 1, 2, 3 years, whatever it is that's your, marker for success. Is there a path to making 10x that or 100x that? Because the average venture capital firm expects most of their investments to fail or break even, and breaking even is 3/4 of a failure anyway, because they're not there for marginal returns, they're there for the big boy returns. So it's like, okay, if your business can't go 10 to 100x, you fundamentally don't even fit the criteria, like the financial market availability, market potential criteria to even get investment from them. Now, I want you to couple this onto, imagine if that venture capital firm has a $100 million fund and they're writing checks of, 5 million, 10 million. It's like, okay, well, that means they need to be able to put 10 million in you, get 10% of the business, whatever. So they're valuing you at 100 million and they want you to 10x. They want you to go to the billion because that's what they need in order to make that investment worthwhile. You compare this to a smaller venture capital firm, someone that's writing, or an angel investor, someone that's writing, $100,000 checks, $25,000 checks, the low millions checks. Well, they can get, 10% for $1 million. It's a $10 million company. And a lot more companies can go from 10 to 100 million than can go from 100 million to $1 billion, obviously. So it's just a question of, okay, if you're going to build something, does it even fit the fundamental criteria of startup investment? From even the most VC investment, from the basic, and then there's so much more, unfortunately, but the basic standards of ability to scale efficiently, ability to monetize at scale, bring in cash in a lot of different ways in a perfect world. And really differentiate in that way.
Every year.
Yes.
What percentage of those are venture funded?
Cool.
We could ask ChatGPT, but I would guess definitely single digits, if not less than 1%.
Yes.
And so if you just look at businesses that are started in the world,
yes,
it is like a weird outlier freak occurrence
yes.
that is a VC funded business.
And right there, I think is something so important. Most startups, like less startups receive VC funding than startups that fail. Which means if you're a founder that's telling yourself, I need the funding or else my business doesn't work, there are very few where that's actually true, but most can never receive a penny of VC funding. Maybe it's banks, maybe it's loans from your friends, maybe it's your own personal investment. Like sometimes you just have to spend money. Like, what are we talking about, right? But you never have to talk to any of these guys, and you can literally have $100 million, $1 billion business and just do it yourself and not have these pressures. Now, if they add value, by all means, use them, do the whole thing, whatever. But if they don't force yourself, into there if you don't have to get into there.
And so, but I think if you're just consuming content, you're watching media, you're watching YouTube,
Twitter,
you don't realize that.
Yeah.
Okay. And venture capital as a product is specifically for investing in something where their investment could be worth at least 100 times more, if not 1,000 times more.
There it is.
And so trying to put that jet fuel into something that isn't going to grow to be big, everyone is going to be sad and lose.
Yeah.
And so you shouldn't do it.
The founder and the investor. No one's going to win. And the user. No one wins.
And so again, I don't think that there's this push that I can see from investors to try to convince people to raise VC money for something that has no chance of growing like that. It just doesn't make sense for anybody, okay?
I'll go a step further. I think the whole argument is fake news, right? I don't think this is a real argument, right? I don't think that anyone thinks it's more moral or good or right to start a VC-backed company or a non-VC-backed company. I don't think this is an actual debate.
Yeah.
I think that starting a VC-backed company, really hard. Not the best way to get rich. Not the best way.
I don't know if it's like a morals thing. I'm not really sure where that's getting pulled from personally, but I think it's more of a what's the market approved way of doing things? What is the beaten path? And I think that it's been long assumed that the beaten path is venture capital because, of course, that's what's in the headlines. But that's not necessarily true. There's so much more opportunity out there, but you don't see it if you're only focused on what the VCs say. And this is coming from, someone in that world so deeply. If you're going to believe anybody, who am I? But it's kind of real.
Relatively small numbers. The numbers are not huge.
Not a good path. I always like to equate it to athletics. It's getting into the NBA is really hard. Not the best path to have a good career is to be I'll just make the NBA.
Yeah, that's simple, right?
Yeah, it's 450 guys. I'll just be one of those guys, and then game on, right? Right? They recruit from all around the world. I live in the world.
Yeah, very straightforward, Michael. I like that plan.
Yeah, no. So this is not the only way to get rich. Let's take a further step. Most people who are rich did not raise venture capital dollars.
Yeah, that's right.
Did not start
real
companies.
estate investing, stock market investing, being lawyers, being doctors. Again, go look up the numbers.
Investors. Yeah, there's so many people, right? So this is not the only way to get rich. I think the other thing that's funny is there is no one trying to force you or cajole you into starting a VC-backed company. If you don't want to do it, don't do it.
Correct.
It's also a decision that you can revisit. If you don't want to start a VC-backed company now, but like your Bootstrap product starts doing well and you want to do it in the future,
great.
you can. There's no one who is going to say no. You said you were bootstrapped on Twitter. I will not give you money. Like, no. I'll get another truth. Empirically, none of the trillion-dollar software companies are bootstrapped with no VC dollars ever.
Yeah.
So if someone's telling you can make a $1 trillion company, maybe you can. Just no one's ever done it.
Yeah.
And I think that's part of the big thing. Like, scale matters. If you're trying to go to $1 billion, like that is a very different scale than just these little tiny, and again, you wouldn't think it. I wouldn't fully appreciate it if I didn't have background in investment banking, where I've just seen spreadsheets and spreadsheets and spreadsheets of 50, 20, 100, $1 billion companies where they're just one line on a sheet amongst thousands. And it's like, oh my God, how big are things out there? Like, there's just enormous companies where 100 million doesn't even scratch the itch. It's like, all right, well, if that's true, that means on a relative basis, again, industry to industry, stage to stage, etc., 100 million is kind of small. Like, it's big, but from a startup perspective, it's kind of small. And if you're really trying to go from that 100 million to the billion mark of valuation, the idea that you're not going to need a lot of capital unless you're just the most efficient company ever. And not only are you good at generating value, but you're good at generating cash. Because remember, you can have a lot of signed contracts and then it takes 6 months to get the cash. You're broke for those 6 months. So often you have to, get capital or get financing from other places just to make sure that, of course, you have day-to-day operating budget and, fair enough, because you have to operate. So then you can imagine you're trying to make multi-year, long-term investments in your business. Like, you're a $400 million business trying to get to the billion. It's like, yeah, you're probably going to need to spend 10, 20, 30, 40, 50 million, per period, per quarter, per month, per whatever. Where are you going to get that cash? Like, if the bank's not lending it to you, it's highly unlikely you're just sitting on mounds of it. You're going to want somebody that sees the vision and sees the risk and is willing to give you all that capital in exchange for, a fair deal. And fair here is very relative.
I'll say fact-based.
And again, like, to look at the numbers, even if you look at software companies, even if you look at iPhone apps, if you actually did an audit of the App Store and you said what percentage of the apps in the App Store are VC backed, it is tiny. But if you said what percentage of dollars that are spent in mobile apps go into VC backed companies, I think that's very right, because dollars are going into Amazon and eBay and like all that kind of stuff, right?
Yes. And by the way, I want to be clear. Neither of us are saying you should want to make one of those companies.
Yes.
Or you
that should come from inside of you.
Exactly.
Not from YouTube.
No.
Right?
I actually kind of try to convince people not to. It's like,
because if you need to be talked into it, that's
the same cloth.
Yeah. So I like to talk about why it sucks. Yeah. So I think the other thing is that no one is trying to say in our industry that if you make a great software product that allows you to make enough money to live a good life, and it's not VC backed, that you haven't won. You won.
There it is.
Yep. Like, I had a friend who made one of these companies. You might have used his product. His product generated about $30,000 to $50,000 a month, and took about 7 to 10 hours a month of maintenance. Mm-hmm. The entire time I was working on my startup, he was living life. Like, I would watch his life on Facebook and be like, this is amazing. He traveled the world, he got married, he had kids. I'm like, he won. Like, that's like good for him. Like, there's no
again, this is the one-sided thing. Is that we're like, great.
Yes.
Like, we're like high-fiving that's dream
amazing.
Versus that there's this two-sided battle.
97% of the time I was watching that Facebook, I was like, am I the idiot? And like, the evidence was like...
Quite possibly, Michael. Quite possibly.
Yes. And he's still doing great, right? And so, like, this is really clear. It's like building a great small business, small software
Even
business.
the term small bothers people. It's just non-venture backed.
Yeah, non-venture backed.
It could be big, non-venture backed.
You're making millions and millions of dollars. Yes, totally fine. I think the other thing that's kind of maybe a dirty kind of underbelly here is who is spurning this argument? Like, who is who's incentivized for this to be a big issue?
Yeah, I think that this has been just like a topic that
I think a big part of it comes from like the culture of startups, especially like at the more junior levels. I experienced this so much in Miami, and it's one of those, the clearest example is I'd go to an event where there was someone who had exited a company who was like their head of products, and they were talking about this and talking about that and how they focus on user experience and how they balance, the collection of data versus, security and like all these really cool things that help you understand how to prioritize the development of, complex products at scale. 30 people, 50 people, like people, sure, a number of people, but not that many. Now, the next week on a random Wednesday, right, there's an event and it's 4 VCs are coming to give a talk about whatever. There's like 300 people in the room. And there's 300 people, like 20 of them actually like have the stones to go talk to the VCs. 3 of them have businesses that are at the level or even the right industry for the VC to talk to. And it's like, listen, I know that everyone wants to be here because, monies, but man, I thought we were here to build products and businesses, not raise money. Raising money and doing finance and doing all this nonsense as a finance person, like this is back end. This is back office. VC is a back office thing. The job of the venture capital is to help, is again, from the base, assuming they're not doing biz dev and stuff for you, is to give you money. That means it goes in the account and then you allocate it per you and the CEO, CFO, COO, head of product, like how the executive team determines and, partnership with the board, blah, 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 how to actually spend the capital. But notice it's not you're in the driver's seat, especially if you don't own a ton. Like if you own 50%, 51% of the business, go off and, be pissed and yell and vote and use all your corporate rights. I mean, hell, you got them. Like, what the fuck? But if you don't have that and you're along for the ride, like by all means, add value where you can. But remember, if the money could come from somewhere else, or worse, if you didn't need the money, you wouldn't be having this conversation. You, the founder, you wouldn't be interested in wasting time talking to a VC because you have product you could focus on. You have customers. Someone's getting attacked. But it's like you have customers, you have product you can focus in, you have all these things that you can do rather than spend time building relationships that have a 0.0001% chance of turning into capital for your business. Again, it's not being anti-VC, it's being pro-good VC startup connection. Are they arresting people on my street?
That gets a lot of engagement online.
Yeah.
And so,
yeah,
if you want to get people agitated about something, this is a pretty good topic. And then you can use it to promote stuff. And so, I'm not going to name any names, but I can think of folks over the years that are like kind of built a following around encouraging people to do this. And to the extent it is helpful and more people are improving their lives doing it, that's great.
Yes.
But there's a little bit of like creating a fake controversy
and then monetizing it.
a little bit. And so maybe people may have this question watching this video. Michael, why should I apply to YC? Like, why should I do a venture? You guys just did a great job of explaining why not to do it. Well, why should I do venture?
So I think that
well, just to note here, like applying to YC is very different than just getting a venture backed company, because you can just go get VC capital from a networking event and meet somebody. YC is a whole thing. How I mentioned earlier, it's like, are they just giving you capital or are they doing biz dev? Like YC is teaching you things, making introductions. They're helping you mold a lot of your business. And just, again, I'm sure they're challenging you from the experiences that I've spoken to people about with in there. And of course, all the just general, I've helped with Techstars and I've helped with a lot of other companies in that universe and, ones that are like it. They're doing a lot more than just handing you the money. Therefore, if you're considering whether to join them, like a big question I always ask is, in joining not just a VC, but an accelerator, right? what are you actually getting out of it? And if you're going to them, one of your goals is not just to get money, but to get the YC name, the YC connections, the YC biz dev. It's like going to Harvard. Being there is great. Carrying the Harvard ring and meeting everybody else from Harvard outside the walls of Harvard is better.
There are some businesses where you actually need money up front.
Yes.
And if
Exactly.
you need money up front and you're building a software business, the venture capital industry can help you get money up front.
Completely
If
agree.
you don't need it,
Makes total sense.
don't take it.
Yes.
Bingo.
I think that what's so interesting about this is that there aren't many other good mechanisms. Like if you need millions of dollars or $10 million to get your company to break even,
Yeah.
there aren't other mechanisms
No.
in our economy to give that to you. If you're building
Let's
a
use an
software
example
company.
of
And that's the big thing. It's about what type of underlying business is looking for capital. If you're a business that's making $100 million a month in profit, guess what? You're going to have no issues going to any bank that has any name that we would recognize and getting all the money in the world that you could ask for on very favorable terms, I'm sure. But if you're an idea stage company, right? And again, at idea stage, there's two types. Those, like Michael just said, that they require venture capital. They require capital up front because, of course, it's just a necessary part of, hey, we're going to build an aerospace company. So it's like, yeah, okay, you're going to need some money like day one. Fair enough, right? We're doing complex things with GPUs. It's like, all right, well, you probably got to buy a bunch of them, right? So, all right, so we need money up front. This is different than I want to build a consumer app. I can draw something up in Figma that looks like it. Even if it doesn't work, it can look like it in, a couple days, a couple weeks, whatever. Thinking through that in terms of the type of business you're starting is one piece. So type plus status, because if you're a really advanced, complex business, but you're making a ton of money, you're fine because you have assets, right? The bank is extra excited to give money to you. But if no one else wants to give you money and you're able to come across startup people, VCs, whoever that do, and the exchange is, right? Yeah, I'm not going to charge you interest, but I get a piece of the pie. I get a piece of equity. If that's the best deal, and especially if that's the deal that is necessary for your business to progress, you should take it, right? Again, all things else being equal, they're not stealing from you or tricking you, net, they're a positive influence on the business, et cetera. And again, everything's a risk. Starting a startup's a risk. Bringing a VC on is a risk. Going to the bank as a startup is a risk. It's all a risk. You just have to push through the risks and, walk through the fires enough to get through the failures to get to success in that way.
Google, I don't know, just because famous, one of the most valuable companies in the world.
Yeah.
I don't know how you could have bootstrapped that. And so again, maybe the audience is saying, well, I don't want to build Google. Great. No one is
build
saying you
Google.
have to build Google.
But if Google wants to build Google,
But if the founders of Google want to build Google,
It's like founder peer pressure. If you're not making $1 billion company, you're a nobody.
Done it.
It's like,
no
how does
bank
that make
raising
sense?
money.
Yeah.
There's no loans they could have gotten to buy the servers and do the things they did.
no. And so we should just be thinking about VC as enabling incremental entrepreneurship that wouldn't be around otherwise.
Yep.
Not as cannibalizing anything. Like it's just enabling that incremental founder. And the other thing is you have to remember, if you want to raise a lot of money, but you can't explain to the investor why you might IPO and give them a lot of money back, then you can't raise VC. We want to be explicit. Like,
This is one of the big things that I and it's not fights, it's heated discussions, whatever you want to call. But I try and teach a lot of founders this because they come to me and I describe them as heart founders or head founders. And obviously, I think it takes a mix of both, because if you're just a head founder, just thinking and trying to logic through it, it's not going to get you through the hard nights. But if you're just a heart founder, well, you're just going to be respectfully an emotional wreck that doesn't know how to make good decisions. And we know how that goes. You know how that goes, right? Everyone has those moments. And when you're looking at like the difference of these two individuals, I talk to a lot of founders that are in the heart founder camp, and they're so impassioned about what they're building that the idea they're so impassioned about the things that they're building that the idea that someone else could not see value in investing in it just seems insane. It's like, well, people really need what I'm building and it's whatever. It's like, okay, well, how much revenue the first year? Well, it's not going to get revenue. It's like, well, listen, we're like, you want me to care like it's like a cause. Businesses for investors, by and large, are not causes. They're investments, which means they're expecting a return. They're projecting a risk associated with that return. They're trying to be strategic with where they place their money, understand the time value of it, and when they expect to get it back. Like, this is not a game of them, again, very respectfully, caring about you, because that's not their job, right? You're going to a doctor and asking him to make you a pie. He's not there for that. He's there to stitch you up. So need stitches or respectfully get out, because that's not why you're here. And to expect something different, it's not the doctor's fault. It's your fault. And it's just you're not informed, or maybe a little hard-headed. Or in this case, you know, the heart founders, a lot of them go, I've had one, and I mean this very respectfully. I had a founder one time say the phrase, oh, Aaron, like, I don't even care about like generating revenue. And they were talking to me about getting like VC money. And I said, all right, I'm going to be the VC. And then I looked her in the face and said, I just don't really care about investing in your business. And the look of shock on her face was, why? And I was like, oh, well, I just don't care about investing in bad businesses. The same lack of care that you don't have for making money because you just care about helping the customer is the same lack of care that I have in businesses that don't make money because they're not making money. I want them in a perfect world to do both. You only want to help the customer, not make money. That's not a fair equation for me. Therefore, no. And I did this again. I'm, 33% of an asshole, whatever. But it's like, I did this to give her an experience of being like, oh, wow, someone can, as impassioned as I am about saying that this matters and that I don't care about the money or whatever, someone can come back at me with the exact opposite with very compelling evidence. And if I want to continue to, have the conversation, to do the dance, I have to improve my answers. And then a couple weeks later, I ended up meeting up with them. And guess what? There was a revenue model. It wasn't complex. It wasn't fancy, but it valued the investor. It said, hey, if you're going to take the time to put money into my business and try and help me build something that helps my customer, which is what she cared about, then I can do the right thing and attach a business model that allows you to have a business worth investing in. And there we have a little bit of, things fitting as they should. There's a good meshing of aligned interests. Everyone's always pursuing their own interests. Fine. Some people get mad at this. I find it silly. But it's about, can you align your interests with someone else in a way that you both win with a common outcome? You win by building a big, giant, successful business because you get to help all your customers. They win because you build a big, giant, successful business that gives them lots of money in return. A fair deal, right in the middle.
It is a business transaction. It's not a faith transaction.
Correct.
There it is.
It is.
It's facts,
I give you
not
money
faith.
now. You give me a lot more money later, or at least you try really hard to.
Bingo.
And if you can try really hard, but the result can't be a lot of money, I shouldn't logically give you money now. Not because I don't like you or because you're not
It's
a great
pure
person,
logic.
or these
This
users
is
you're
not
trying
a
to serve aren't great.
judgment
It's just
call on
because
your
it's not a good business
personality.
transaction. It's literally nothing personal. And I think sometimes founders kind of are very confused when VCs say no.
Well, it's because, again, if we're trying to stoke outrage,
Let's stoke some.
Here's a big one. Founders look at VCs like they're people instead of, worker ants. And it's not that they're small or anything like that, but a VC has a mandate. The ant colony has a mandate, right? And in a VC world, or when you raise funds, your mandate is basically what you're allowed to invest in. Sometimes it's the industries they are in. Sometimes it's the geography. Sometimes it's the type of founder, right? We invest in North America. We invest in women-owned founders. We invest in energy, again, whatever. But if the VC doesn't have your industry on their mandate, you could be the best company in the world and they can't do anything. Now, mind you, if you're the best company in the world and you don't fit their mandate, maybe they invest in you personally if they invest outside of it. Very, 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 very low likelihood to note. Or more likely, maybe they have a referral, because these industries and groups, you can imagine there's not that many people that do this at a high level. So they can maybe go, hey, you know, I don't do this, but my colleague or this woman that I know, Sarah, she is part of a fund that invests in just that industry. Let me make an intro. You seem like, you know, a top-notch person. I love the business. I love your energy. Great. But notice, even then, the best they can do is give you a connection to the other person that can help you. It's not like they're giving you the money. And a lot of founders, they take it so personally, like, oh, this VC doesn't want to talk with me. And I go to the VC's website and they go, we invest in B2B SaaS. And I'm talking to an aerospace company. And it's like, guys, if you can't read, not read the website, what you're showing me is you just can't read at all. Like, if you can't read, we can't do this. Like, how are you going to expect this VC to take you seriously at all? And let me ask you, if you were them and they saw your message about wanting to talk and you clearly didn't read their website about them investing in B2B software and you being an aerospace company, even if your business was good, do you think they'd make an intro? Or do you think they'd go, who are these people? They can't read. It says on the front page of our website that we're a B2B SaaS thing. Like, what are they doing? You end up making a fool of yourself, or at least ruining your chances. Because remember, they don't have to respond to think you're an idiot. They can just get the email or get the message and be like, oh, I guess, you know, Tom, whatever, I guess he doesn't know what the hell he's talking about, because he's showing me in this email he has no idea what the hell he's talking about.
Not right. You point at something silly that raised a lot of money.
Yes.
The most extreme, silly thing in the world. No.
You always pointed Sarah.
That'd be one. Right?
Silly things that raise a lot of money is one thing, which absolutely is fair, because big things that raise a lot of money that have fundamental issues speak to the lack of quality and a lot of due diligence processes for investors. And this isn't an attack on investors. It's a reality. If you invest in WeWork and you see that their business model is a bad one, but you think that it's still going to get bigger, and you don't diligence it properly and think through the implications, like, that's on you. Like, you're not thinking through this properly, and your diligence process failed you. And it failed you because they probably invested because of FOMO, right? Fear of missing out. Investor A is coming in, then investor B is coming in, then, oh, I got to come in at investor C. I've seen some VCs write some checks quick in, you know, what normally is a process of months becomes weeks, days, hours, because, hey, let me get in on this. Cold offers of, hey, let me put 200K in your business for people that you haven't even spoken to yet. Like, that is the power of FOMO and everything. And you take that one step further and you go, okay, well, every startup business, one of the reasons I don't like analyzing startup trends, because the situations surrounding each business are so unique. For example, I was working on a business back in the day, and one of the team members said, hey, like, why can't we go raise money? Why can't we do this? Like, this other company raised a bunch of money, blah, blah, blah. And I go, all right, well, let's just look it up. And they're like, they raise money at idea stage. Like, what is this? Like, we've done X, Y, and Z. And I go look up that person, the company. I look up the founder. I look up the investor that invested in. And then I went to that investor's homepage. And then I looked at the homepage. I went to the team and I saw the same last name of the CEO of the managing partner was the same name as the founder of the product. And I just send a screenshot to that client and went, I wonder what could have possibly driven this investor to put that money in this hyper early stage business at blah, blah, blah. And guess what? That client, you know, they didn't respond because, you know, what are you going to do? But it's like, yeah, like, this is, it's so obvious when you know the game and you've been in the game that, like, if someone's raising money that seems crazy, unfair, unrealistic, etc., it's probably because there's more to the story that you just don't know about, and you're better suited by just putting your head down and working on the realities that surround your business versus want to be another business which you aren't. I always try to frame it with founders of there's two types of founders: those with resources and everybody else. And if you're not I have connections that have millions of dollars, I live in California, I live in New York, and I've got money and I'm in the startup scene, if you're not one of those, you don't have resources. You're just one of everybody else, including me, which means we have to do it the old-fashioned way: generate value, de-risk investments, show that people have demand for things, like just put in just the unbelievable amount of work, but the real work that shows it's worthwhile. And then when you have something that's worthwhile, you can imagine, you couldn't raise $1 million at idea stage because your dad's name isn't on a building. Fine, whatever. But now you spent 6 months building a lead list of thousands, building an MVP, raised off half money you put in yourself and half from different friends and mom. You did all of this. Now your business has, 5, 10, 20, 50 grand a month in revenue. Now you go raise money, and guess what? Now where you struggled to get $1 million in total, you're getting $1, $2, $3, $4, $5 million check offers because people see the potential. They see your grit. They see everything that you've been able to accomplish with so few resources. It's everything you could want as a founder can be found underneath the hard work. There's a lot of it, and you're going to go through a lot of shovels, right? But you can get through it without a doubt.
Or WeWork, whatever. Like, you point to something that is like on face silly, and then you say, well, if they funded that, why won't they fund my social network for dogs?
Yes.
And so it causes a lot of emotions.
Yeah.
And I understand, I relate, but don't fall for the rage pill. Don't let yourself get enraged by obvious engagement bait, which is to cherry pick the craziest, silliest thing, and use that to get all worked up and take that personally, like that somehow hurt you, like you were hurt by that thing over there happening.
Well, and what's so funny is like you are actually clued in on the real truth, which is that they screwed up. Someone messed up. Like, you're right. They shouldn't have gotten that money. Like, you nailed it. That person who funded that company. The
other side of this, which is a big thing, is it's very easy to celebrate all of the victories, the billion-dollar companies, the Sam Altmans of the world, the OpenAIs and Perplexity and everything else. But it's equally important to remember all of the major startup failures that, happened because of just too much money, too little attention to detail, too little demand, and 100 other very avoidable, or at least discoverable without spending billions of dollars, certainly, problems.
Company is an idiot, and you're exactly right. But like, hey, that doesn't mean we should.
All bets are off.
Yeah,
it's like, okay, this dumb thing happened. Therefore, up is down, black is like forget everything we know. That doesn't follow. That logic doesn't make sense.
That person should probably be spoken to about their investment strategy. So just understand that game. And I have to be honest, like, I like games like this. Like, I don't like games where you have to like convince people to like you or to align with your views. Those are games that are way harder to play. I like games where it's like, hey, if I want to serve this customer and you can be a good legal partner to me, and I give you money and you give me legal services.
Right there. I love that energy, because it's as, again, just the average everyday founder like I am in that way. It's energy that I definitely have found that works the best in my day-to-day life. It's always better to focus on the business than, trying to look like something that you're not, trying to have these crazy relationships, trying to schmooze at the most important events. It's important, I think, in the early days, if you haven't built a startup, to go out and to put yourself out there in the world and in the culture to kind of just see what it's really like and see what's going on. But I also think it's equally important to maintain a certain arm's length away where you learn to rely on yourself and learn to rely on your partners and learn to do business, which means exchange, value for value. If I need legal services, here's the money. You're a good lawyer, do the thing. And now the business is one step closer to being bigger, better, whatever, your goal happens to be. If the goal is an exit, well, great. Now we're incorporated. Now when we go sell the thing, we actually have something to sell. That's a huge win. And it gets so overlooked because you're trying to go to an event with 5,000 other people to talk to a venture capital firm that doesn't invest in your industry with an idea that you haven't tested. It's like, sure, like go if you want, but I can think of a lot better ways to waste an evening.
You can be a good funding partner for me. I give you a check at my company, you give me cash, right? If you can be a good partner to me, a simple to understand partner to me so that I can spend my time working with my customer, that's what I want.
Yeah.
The customer's complicated enough. Jesus. The customer is complicated enough. I like the idea that the money people are like, so if I give you this money, maybe you give me a lot of money back? Yes? Okay, we're good. Okay, we're good. All right. End of conversation. I give you money, you don't give me any money back? No good. Come back when this is out that way. Hopefully this helps clear up the debate, but I secretly hope this doesn't at all, because this is like so silly.
It is funny to watch, especially once you know the game and see how it's kind of played and how to better optimize for decisions, whether you're taking money or not taking money. Seeing people fight over what's the right thing to do, take money, not take money, it becomes, it's silly. Exactly. It's fun to watch, not because, it's crazy, but it's like, guys, if you just took like 3 deep breaths and actually thought about what was best for your business, you probably wouldn't be doing 2/3 of what you're doing. You definitely wouldn't be arguing over whether it's better to bootstrap or, raise VC money. You'd be going, well, in order to get through the next 6 months of my business, it looks like I need to spend 10K and I want to spend 50K and I only have 20K in the bank. Okay, well, now I have a choice. Do I want to try and get VC money? Do I have a business that's VC available? Do I want to try and get other types of capital? Or do I just want to spend what I need to and bide my time and do what I need to do in the meantime to progress the business, solo, whether that's hiring people, working on processes, building out better systems or, better standards for bringing value to customers. It's all about what you want to do to, build and grow your business, not how you fund it. How you fund it is just how you fund it. It doesn't have a major implication in that way. So hopefully this was helpful. I love the video. It was great. I chatted a whole bunch, and we'll see you next time.